Hello, thanks so much to everyone for joining us today. We're so excited to be here with you. Please feel free to drop in the chat box where you're calling in from. My name is Jessica Jacobson. I'm the Director of Deposit Strategy and Operations at CNote. CNote is an impact investing platform that helps credit unions to invest in underserved communities at scale through access to a new source of deposits. And that source is from corporations and large foundations that might typically have their deposits in a corporate bank account. We're able to help make those linkages to instead help them move their funds to community institutions that are making a difference in their local community. I'd like to go over quickly what we'll be discussing today. We're going to focus on three key areas. The first is the market environment and current economic picture. The second is tips for navigating current challenges. And the third is expectations for the future and ensuring success. We'll leave a couple of minutes at the end for questions. So if you have questions, please feel free to add them to the questions tab below. And we'll also be recording this webinar, and everyone who's in attendance will receive a copy at the end. We have an incredible group of panelists here today, and I'm going to let them introduce themselves. We'll start with Rodney Hood.
Yes, good morning, everyone, or good afternoon, depending upon where you're located. This is Rodney Hood. I'm a board member of the National Credit Union Administration, and we are the prudential regulator for America's credit union system. Delighted to join you all at CNote today. Thank you for having me.
Thanks so much. And Renée Sattiewhite.
Hi, I'm Renée Sattiewhite, and I'm the possibility of people serving other people passionately. I am employed by the African American Credit Coalition, and I'm so happy to be here. Thank you for having us.
Wonderful. And then we're also expected to be joined by Mike Schenk, who is the Deputy Chief Advocacy Officer for Policy Analysis and the Chief Economist at CUNA. And I hope that he'll be able to join us shortly. But in the meantime, we'll move ahead with our two wonderful panelists. And to start our discussion, I think it would be useful to level set on the current economic landscape, its many challenges, and its impact on credit unions' work. I'll start off with a broad question for each of our panelists, and that is, how would you describe the current economic landscape and its potential impact on credit unions? Renée, would you like to start?
Sure. I would say that our current rolling recession, some unemployment sectors that specifically Black unemployment is on the rise. And this tends to be a leading factor, but people of color are the last hired and the first fired, so tending to work more from frontline positions. So I'd say that the economic landscape is, especially with the Supreme Court recent rulings, have people a little bit in an uproar and a little concerned about where we're going to go and grow with those types of Supreme Court decisions. So I think that more than anything is what's going to have an effect on the economy going forward.
Thank you. Rodney, would you like to share your thoughts?
Yes, I would. I'd just like to say, as the regulator, we're looking at a number of things that credit unions are navigating in today's environment. We have a number of headwinds, whether it be inflationary pressures, whether it be the geopolitical climate that we're seeing between Russia and the Ukraine. We're still seeing a lot of fallout from the COVID-19 pandemic. But in spite of all the headwinds, that we've experienced, credit unions are no strangers to navigating during turbulent times. If we think about how credit unions came into existence nearly 100 years ago, when hardworking men and women couldn't get financing, what did they do? They galvanized, reached into their pockets, and they created today's system of cooperative credit. So it's against the backdrop of adversity that credit unions tend to do best. And that is certainly apparent now. In spite of all the inflationary pressures and things that we see in our midst, credit unions are still today able to play a vital part. They're serving some 135 million members throughout the United States. We have about 4,700 credit unions that we actively oversee and insure at NCUA. Assets to date approximate $2.2 trillion. And the one thing that I'm seeing that credit unions are doing in the midst of all the uncertainty is that they're still making loans to their members, and they're doing it quite well. In fact, $1.7 trillion in loan outstandings. That means our credit unions are making the loans that are needed for cars, for the members to get to and from work. It means that they're getting sustainable mortgages because they need affordable home ownership. So credit unions are doing that. And they also are making business loans available for those entrepreneurs who are creating businesses that stimulate the economy. Credit unions made over 310,000 PPP loans during the pandemic, and they're now able to continue that goal of providing capital. Another indicator that I look at is, are they lending? Yes, but also are they doing it responsibly? And I say yes because of their high quality of the loans that credit unions are originating. And we have a very high capital level, you all. Capital levels today approximate 10.7%. That's almost 400 basis points beyond the 7% statutory requirement. So you all that are listening today, credit unions are thriving by way of their capital. They also, I want you to know, we have a very strong national credit union share insurance fund. Those 135 million members, their accounts are fully safe and insured up to $250,000 per account at NCUA. And no member with an NCUA insured account has ever lost a penny. So yes, against a very dramatic backdrop, I'm pleased that credit unions have the tools and infrastructure to succeed and compete.
Thank you. Mike, I'm so glad you're able to join us. Would you be able to briefly introduce yourself and then share your thoughts on how you would describe the current economic landscape and potential impact on credit unions?
Sure. Thank you very much. I'm really happy I was able to join you as well. It was kind of stressful for a minute or two there, but I'm Mike Schenk, and I'm the chief economist at CUNA. That means that I spend a lot of my time running around talking about the macroeconomy, but the actual reason they send me paychecks from time to time is to serve as an advocate. I'm a registered lobbyist, and so what I do is I spend a lot of time, and my team spends a lot of time trying to come up with data, proof points to show policymakers that credit unions are different, that there is a transformative power of cooperative finance, and that we make a really big difference in our members' lives and can do even more with policy prescriptions that would help credit unions reach more people. So that in a nutshell is where I come from. And I think to answer your question, and maybe just put a little finer point on what Board Member Hood just said, just from a macroeconomic perspective, I would say I would characterize the current environment as uncertain and unprecedented. And to put that in perspective, uncertain, we do quarterly economic forecasts here at CUNA and have for the 30 plus years that I've been here. At the beginning of each one of those forecast sessions, we ask the question, what is your probability of recession over the next 12 to 18 months? And there are 7 of us that participate in that process, 3 current CUNA economists and 4 ex-CUNA economists, including my predecessor, Bill Hample, and the chief economist over at, I guess they call it True Stage now, CUNA Mutual. And when we went into the meeting for this last forecast, we saw the greatest variation in responses to that kickoff question that I can recall in my 30 plus year tenure here at the association. So at the low end of the spectrum, one of the economists said, oh, I think there's a 45% chance of recession. At the high end of the spectrum, my predecessor, Bill Hample, said 75%. So that's a really wide and oddly wide range of views on where we're going. I say unprecedented because we've now been living with, for over a year, a pretty steeply sloped yield, or I'm sorry, an inverted yield curve, a pretty large difference between short and long interest rates. And that inverted yield curve almost always historically has sent a strong signal of recession. It's one of the best historically indicators of recession. And it's very strange that we're this far along with that big of a move on the part of a Fed and that much of an inversion in the curve. And we're still seeing a really strong job market, and the unemployment rate, I think now is 3.6%. Pre-COVID, it was 3.5%. So that's kind of where I'm coming from at the moment. We are not predicting recession at the moment. And that doesn't mean that we don't see tough sledding ahead.
Okay. Then I'd like to steer the conversation into the crux of our being here today, which is, navigating the challenges that credit unions are facing in this environment. Starting with Renee, in the face of the liquidity crunch, what types of innovative approaches have you seen credit unions adopt to ensure that they have adequate liquidity while continuing to meet the needs of their members?
One main one is looking at transferring your credit card, outsourcing your credit card program. ACC has a credit card program within Facade, but changing it to a third party. There are plenty of vendors who are really well capitalized to take that on. This improves liquidity and reduces the loss of exposure. So those are that's the main thing that I've seen. That because I'm not an expert in credit unions, I'm an expert in people. So Rodney and Mike do a better job of the money stuff. So just the credit card portfolios or somewhere I think that is a good way to reduce your risk exposure if you is outsourced to a third party.
Great. Rodney, I'd love to hear from you a bit about policy-related solutions and opportunities. What type of regulatory changes or reforms do you believe could alleviate credit unions or alleviate the challenges that credit unions face in attracting new members and expanding their membership base?
I think one of the major policy changes that we need to look at in terms of how do we bring in new members and how do we create new de novo institutions. I think one step in the right direction was that we as a board are now looking at the provisional charter. So that means that if you have a valid proposal and you're showing that you want to serve underserved communities, you want to create and become that port in the storm where we have financial deserts. We at NCUA are working on field of membership. So we're looking at some of those issues around service facilities. No longer does a credit union have to build a new branch for several $1 million. They can now invest in an ATM or a video network. How do we continue to provide pathways for serving the underserved? So we're looking at other opportunities around strengthening our MDIs, the minority depositories, our CDFIs. We are providing grants. For the first time ever, we're providing grants to our minority depositories. Typically, we'll provide grants through our low-income designated, our CDFIs, but because we recognize that we can play a role in really helping credit unions grow in today's turbulent marketplace, there is a role that we can play in really providing greater capacity building, infrastructure, and things of that nature. And I think another thing that you will probably see us looking at in terms of meeting some of the issues today, and that is having a more focused exam. We used to, I wouldn't say we always do a one size fits all, but we recognize that if we're going to not only create new credit unions, but also maintain the existing ones, we can't have a one size fits all approach. So we are having a differing approach as to how do we look at the smaller institutions. And I'll give you a case in point for our minority depositories. We're going to stop benchmarking that small minority depository against a multi-billion-dollar institution. We're going to now have a different framework. We're going to benchmark against each other, and also looking at opportunities. If there is an area that we need to do an intervention, then we're going to do those types of things. And then I know one of the other things that we're seeing, we are starting to see a bit of consolidation. And one of the things that I'd like to see that we do more of is if we are seeing consolidation in the industry, and we can't control that, but what we can do, I don't want to see an MDI just completely disappear. So if that's an MDI that wants to merge, we're going to see if we can merge with another MDI or a LIQ with another low-income designated credit union. So those are some of the things that are within our purview that NCUA is working on. I know we're going to talk a little bit about legislative issues later, but the things that we're working on now, I think, can again create new credit unions, which we've had 6 new ones created over the past 18 months. And we have several now in the pipeline that will benefit from the new provisional charter.
Great. Mike, what emerging trends or technological advancements do you see shaping the future of credit unions, and how can they adapt to stay competitive?
Well, I mean, I think the really big challenges are pretty obvious to everybody. FinTech on the one hand, and to be more specific, I think, over the longer haul, crypto and, electronic access to funds that completely change the way people have behaved in the past. And so the question is, can we play a role in that? We must play a role in that. crypto is not dead. Certainly, there's been a lot in the way of challenges, and in my opinion, I would be very cautious about dipping my toe into that water at the moment. But that does not mean that in the future this will not be a real big deal. So I think everything that we're doing from an advocacy perspective is to ensure that credit unions are at the table and they can, be a participant in the market as it evolves, whether I'm right and crypto is a big thing or it's something else altogether. So, I think that's what I hear about when I'm on the road talking to credit unions in strategic planning sessions and so forth. I think, the other thing that comes up immediately in terms of what people are wrestling with today is liquidity. And the number one question I get is, what should we do? And I feel like, well, there's no magic wand. There's no silver bullet. You got to pay up for deposits. It's as simple as that. But there are innovations out there, including the good work that your organization is doing. And so almost always when I talk about liquidity, CNote comes up in that conversation.
That's great. Thank you. Renée, drawing on your experience working closely with credit unions, what best practices or success stories can you share regarding attracting new members and fostering a sense of community engagement?
Well, the first thing is remembering that your member communications is vital. It's very, very important. And what helps people are loyalty and reward programs, right? People want to get something when they're contributing. I know that plenty of my credit cards have loyalty programs, and I'm down for all of them, especially those Sky Miles when I'm flying. But looking at reward programs, looking at your communication, working with schools and nonprofits. Some of the organizations, some of the credit unions are working closely with financial literacy, trying to make sure that they're partnering with these credit unions and these schools so that they can further push out financial literacy. That's a good way to introduce new brands to your community. Youth accounts are still very, very important. And then what would it look like if those youth accounts got turned into mainstream member accounts as they get older? So you want to look at that as well. And then what I'm really seeing a trend in is the credit unions having foundations, looking for deeper involvement with their communities. And in doing so, for instance, SRP, Federal Credit Union, and BECU, creating these foundations for their communities that's going to help where the credit unions have to stop. The 501c3 nonprofit can really pick up the slack in the community. So I see a lot of that, just really reaching out for your nonprofits. And the United Way is a good source of partnership if anybody is interested in that as well. So that's what I see mainly of getting that community involvement is going through those types of channels.
Okay. Rodney, in the current economic climate, how can credit unions strike a balance between meeting regulatory requirements and maintaining operational flexibility to effectively serve their members' evolving needs?
You know what, that's a really good question, Jessica. And I would say that FinTech is one of the solutions to that issue. I am very proud of the fact that we at NCUA have created the new Office of Financial Technology and Access. And that is a group that is really helping credit unions partner with groups that are doing data aggregation, predictive analytics. How do credit unions not just use technology to meet the existing needs of their members, but how do they use that technology to anticipate their needs? How do they use what I would call the lifestyle segmentation approach, when you are able to just really give them wonderful member service? And you do that through using data. I think that's one area. I'm really fond of the fact that we have several hundred fintechs that are working in collaboration with a lot of our credit unions around the country. And I know we often think of them as these disruptive forces, but I look at them as enabling and empowering credit unions with the ability to not only serve their members today, but also to attract even new members. I know you asked me about that earlier, and I talked about field of membership. We have 6 million new members that came to the credit union system during the pandemic. That means that They have come to credit unions because that they know that they can trust those credit unions. They can get access to affordable products. So I want them now to really provide these 6 million new members and the 129 former members with all of the technology that's needed today, whether it be remote deposit capture, faster bill payment access, all of those things. Another thing I think that comes from innovation, it gives that $300,000 credit union that operates in the basement of a church, it gives them the same breadth of talent and product exposure that you would get from a Wall Street bank. So I do think that fintechs are a multiplier effect in helping credit unions not only serve members, but it also reduces a lot of the back office support that they would normally have. And that in turn brings about greater operating efficiency. I think the better use and deployment of artificial intelligence, machine learning, those are tools that as credit unions of all sizes bring those to bear, it would allow them to really have greater operational capabilities. And I know that one of the things that makes credit unions unique is their nature of collaboration. That's why I so value the QSOs. That's why I value how credit unions will all get together and share in platforms by themselves or with each other. I think that's another thing that helps our small institutions survive. So technology, and I also think going back to the basics of making sure that our credit union leaders and board members are fully engaged in terms of, Renee mentioned communication, but also making sure they are just adhering to good balance sheet management, looking at duration risk, all the things that we expect our institutions to do.
Great. We have a question from a participant that I'll throw out to whoever would like to address it. And that is, in light of bank failures, do credit unions see an adverse regulatory rules environment around capital requirements, disclosure requirements, or increased scrutiny?
Well, that's a really good question. And I would love to hear my colleagues' views on that. But as the regulator at NCUA, I mentioned earlier in my opening remarks, in the midst of the headwinds and headstorms, credit unions have generated over 10.7% of the net worth. And again, that's far beyond the 7% statutory requirement. I don't know if I could really ask credit unions to hold any more capital than there already are, because to have them do more capital holding, I don't know if that's going to protect the system. I mean, again, we did determine that a system is safe at 7. If we look into compare ourselves to some of the bank failures, yes, I'm very troubled about what played out with Silicon Valley Bank and Signature Bank and First Republic, to name a few. A lot of the issues that they experienced came from not looking at balance sheet management, not looking at the deposit structure that they had, where over 90% of Silicon Valley banks were uninsured. Contrast that with NCUA, where 91% of all of our systems deposits or shares are fully insured by NCUA. So I don't want folks to think that there is an apples to apple comparison between what we're seeing with banks and their call for greater capital and thinking that that would transfer over to NCUA. I think we were very in front of this issue again in January of this year, telling credit unions to look at interest rate risk, liquidity risk, and all those things. So I can't say never, but I would say I've not seen anything now that would mean that we would go out and raise capital in the midst of some of the other intractable issues that we're dealing with. So we'll let the other regulators look at that issue. But for us, I think we have a very safe and sound system.
Thank you. Would anyone else like to add anything in response to that question?
Sure. Well, I live in Wisconsin, and so I'll just use a quote from the fabled Green Bay Packers head coach, Vince Lombardi, who once purportedly said that confidence is contagious, and so is lack of confidence. So whenever we talk about this issue of failures, it does make me a little concerned. Animal spirits are a really big deal. But as Board Member Hood pointed out, there are large differences that we are discussing with policymakers so that they're aware of those differences. And to everybody who will listen, and to put it in a little bit more perspective, I think when we look at the bank data, there are 800 banks in the United States that have more than 40% of their deposits that are uninsured. 800 banks. Those banks have $15 trillion in total assets. And so that's nearly 2/3 of banking assets in the commercial banking sector. Now, if we look at credit unions, there are 11 credit unions that report more than 40% of their deposits are uninsured. Those credit unions represent 0.02% of all credit union assets. And so it really is, I think, a perspective that clearly delineates credit unions and sets them apart from the for-profit sector. And if you look at insurance fund performance over the last 30 years, as you know, the FDIC has operated in the red on 2 occasions, and the NCUA has operated at least $1.20 per 100 in insured shares over that period of time. Incentives matter. And, you know, when you have a profit incentive in the equation, from time to time, people engage in behaviors that are not really productive and that can end up causing great harm. That's happened historically. So I'm concerned about the situation. I think that policymakers responded appropriately, and I just hope that what they've done is enough, because, you know, confidence is contagious, but so is lack of confidence.
And Mike, I agree with that wholeheartedly. In fact, I was in the UK immediately following the SVB debacle, and there were those there, bank regulators there, who were saying, is this going to be the Great Recession again? And I had to remind them that what we saw play out with Silicon Valley Bank with the long lines and all that, that is not a reappearance of what happened during the Great Recession of 2008. What happened in 2008 was a crisis in credit. It was a crisis in collateral. And what we saw play out most recently with Silicon Valley Bank was, to my point, a crisis in confidence. So that's why you've seen NCUA doing a lot of outreach around letting folks know about the importance of our insurance share fund, that the funds are fully insured to $250,000, letting folks know who were beyond that requirement that they have now been restructuring their accounts. So again, a lot of outreach, but again, it's about confidence and letting folks know that this should not be conflated with what they saw play out before. Another thing that I will say, that as policymakers are discussing if the $250,000 limit is something that needs to be reexamined, I would say that I know our peers at the FDIC are looking at that, perhaps with what's going on with some of the commercial accounts. And while that would be a legislative decision as to if that limit is going to be raised, I want you all to know that I will be paying careful attention, because if there is a raise in that amount for any account with the FDIC, we certainly want to maintain parity with NCUA. We never want to have the banks in a more competitive position where they're able to offer greater insurance coverage. So we're all going to be following that closely. But to let you know that, yes, you're hearing a lot about studies and research, but that would require legislation. And we, again, want to have a seat at the table.
Thank you so much. Mike, would you please highlight some of the valuable resources and support that CUNA provides to credit unions in navigating the current challenges and staying ahead in a rapidly evolving financial landscape?
Sure. Just from an economic perspective and operational perspective, our team does a couple of things. We do, as I said earlier, a quarterly forecast, which we post on our website. We do monthly economic update videos where we choose a topic of interest and record videos, post those on our website. And then we also write monthly trend lines articles, short articles on the economy and operating and financial trends at credit unions. So those can be pretty helpful. And I think, you know, as far as the forecast goes, I have to admit, we're never actually right. We get pretty close most of the time, but the main value, I think, in the forecast is it directionally kind of gives people a good idea of what we expect to happen. And I think from the standpoint of credit union professionals who are interacting with board members, who definitely get a little wigged out when the environment is as uncertain as it is today. Having that outside third-party view into the future and reminders about where we came from and how we should behave in this environment is really, really helpful. The other thing that we do and have been doing now for about 2 years, we obtained the Equifax database. And we have 30 billion records related to credit relationships in the United States, monthly data going all the way back to 2005. And we're using that data to really prove the credit union difference, to prove that credit unions have a meaningful impact in people's lives. And what does that mean on the ground? Well, when we look at Equifax data and we look at automobile lending, we see that credit unions provide way more value in the marketplace than do for-profit institutions, either depositories or non-depository institutions. And for example, across the credit spectrum, we see those savings that accrue to members, but in the lower rungs of the credit spectrum, the savings are quite large. Borrowers with deep subprime credit scores who happen to originate with credit unions save on average in the current environment, real data from Equifax, save on average over the life of their loan $13,000. That's not chump change. That's real money, especially in today's environment. In the same respect, when we look at home lending, 30-year fixed rate mortgages at the moment, credit union members, at the lower rungs of the credit ladder, are saving up to $70,000 compared to the same types of loans that they get from other providers. And actually, that's not only interesting from the standpoint of our ability to talk about impact and the difference that credit unions make in people's lives, but also to start the conversation around how much more we could do. The 18% interest rate cap is a big deal. And in the context of finance companies that are charging 30, sometimes over 30% for loans, just moving that 18% cap up a percentage point or two could help to serve hundreds of thousands of borrowers throughout the United States and really deliver financial well-being to people who need it most. So that's one thing that we're doing on the advocacy front. The other thing is we've built out a website, sort of a subset of our website called Advancing Communities, where we're collecting member stories and pulling all of the data that we have together to talk about in specific communities, rural areas, amongst business borrowers, how we're doing things differently in the marketplace, how we stand out, and how we really do make a difference. So those are a couple of things that come to mind.
Thank you so much for sharing. Have one more question from a participant that I'll put out there for anyone who would like to answer. And this is regarding infrastructure building. How do credit unions balance and prioritize physical brick and mortar initiatives versus digital infrastructure modernization?
That's a really good question. I think one of the ways they do it is with a lot more in guidance and empowerment from their prudential regulator. And where I'm going with that, as I mentioned earlier in that field of membership response, I really would like for credit unions to be able to use their phones, their digital platforms as a service facility. And I am working with our agency leadership and more notably our general counsel that's not allowing us to use our phones as a service facility. But those are the types of things that I think the regulator can play a role in that. Yes, we talk about fintech partnerships, we talk about faster payments and digital platforms, but unless we're able to really evolve and allow phones, which are quite ubiquitous throughout all of our credit union members, unless we're able to find a way of letting that count as a service facility, I think we're going to be playing catch up for quite some time. So my thought about that, again, I think one way to really accelerate that is through us allowing you to do more than just have the teller machines and the video teller machines count as a service facility. I certainly am working still diligently behind the scenes to get us to use our iPhones and Androids as, again, branches themselves, because the brick and mortar piece, I think is still important, especially as we want to serve underserved, marginalized communities. I do think it's important that they have those branches when they do need to go in, but I don't want credit unions to think that that's the only way that they can compete and serve.
Thank you. Would anyone else like to add in a response to that question?
I guess I would just add to the last part of it. We are seeing in the data a real difference in terms of brick and mortar. And I think the really important thing to remember is not so much what credit unions are doing, but what for-profit institutions are doing. And that is they're closing branches at a pretty rapid pace. So depending on the time period you look at, we see substantial declines in the number of bank branches And we see very, very significant increases in financial deserts or near deserts where there's only one or two options in a particular area. And again, when you look at credit unions, you don't see that. So you just see a lot more focus on the bottom line in the for-profit sector, with marginal branches being shuttered at almost a record pace over, again, it depends on what period of time you're looking at, but over various periods of time. And so that engagement with the credit unions tend to have, their ability to stay in the game in underserved areas, and their willingness to enter areas that are not being served at the moment are really, really important. It's kind of disingenuous to hear bankers say, no, we don't want credit unions to expand fields of membership, when they're creating at the same time these areas where there's no access physically to financial services. And so we know that credit unions want to do more, and policymakers, I think, are keen to hear about institutions that want to do that. And part of the reason that that's so important is that we find in the data, in research that's been done, the most vulnerable folks, people with low levels of financial well-being, with low levels of financial health, what they need most is to actually sit down with a human being and have a one-on-one conversation about where they're at and where they want to go, and how they can effectively get there sooner rather than later. So I think that's really, really important, and we're doing what we can to socialize that message.
We're also, regarding the financial deserts that you mentioned, Mike, we are seeing an uptick in the number of credit unions that are able to acquire some of the assets and assume the liabilities of the banks. I know you've heard about the bank mergers. I'm one that thinks that is perfectly acceptable if credit unions are finding opportunities to, again, eradicate those financial deserts. And if you don't have credit unions taking the branches that the banks are leaving behind, or the whole institutions they're leaving behind, you leave these people vulnerable to pernicious and predatory payday lenders. So we are starting to see quite a bit of movement when credit unions, again, they're not buying the whole bank. So I want to dispel any of the materials that are being sort of sent out through some of the banking trade groups. But what happens is credit unions, through a competitive bidding process, they're able to assume the liabilities and acquire the assets of those banks. And in turn, they're able to memberize those bank customers so that they can comply and comport with builder membership. And in turn, these folks are going to be able to have access to affordable products, and they're not going to have to run to payday lenders. So there is something that we're seeing, and I think you may even see more of that. To Mike's point, the for-profit mentality of some of the banks, it differs from the service orientation of credit unions. It's all about people helping people. So I would say that you may see some of those additional opportunities on the horizon.
Thank you. We have one more participant question that we'll put out there before we move on to the next session. And this one is addressed to Rodney. It asks, do you see the NCUA relaxing charter regulations in the future to allow credit unions the ability to serve the broader underserved populations? For example, converting SEG charters to community charters in a simpler fashion.
You know, that's a really good question. I've always believed that financial inclusion is the civil rights issue of our time. We do need more work to be done around builder membership, but I'm afraid that is something that goes beyond the scope of our board. That is beyond regulatory. That's a legislative matter. So as you have folks like CUNA and others and AACUC, as they tell the story to Congress, that's lamentable that it takes congressional action for credit unions to be able to adopt and serve underserved communities. So that's a little bit beyond our purview at this time. But I do think that's something we should really, I can't lobby, but we certainly can.
Wonderful. So we've been talking a lot about the challenges of today and how credit unions overcome them. But given the wonderful panelists we have with us today, I would love to hear a little bit more about their expectations of the future and how the credit unions here can ensure their success. So I'd like to start with Renee and ask, from your experience working with credit unions, what are some of the practical strategies or approaches that credit unions can adopt to ensure their long-term success and resilience, considering the potential challenges and uncertainties that lie ahead?
Well, the first thing I would always say is join the Commitment to Change Credit Unions Unite Against Racism initiative. in joining that initiative, looking at the colored majority, focusing on retention, focusing on the younger demographics, focusing on, again, the colored majority, because that the landscape of the United States is changing and will be full throttle 2030. And so if you're not looking at your credit union demographics that are trending older, we have to start younger. We have to start servicing the young adults to 18 to 35. And then when we're looking at how to service them, we have to relate to them. What products and services are particularly strong for them? What do they want? So credit unions are going to have to start working and partnering with fintechs. That's like, you're not really going to have a choice. You have to start doing that. So investing in fintechs that work with your market and your community would be advisable. You also have to have an up-to-date digital footprint. My background is training and marketing. I can't stress it enough. Marketing is key, and marketing the correct way, making sure that your images reflect what people are looking like today and not looking like my grandpa's credit union. So you want to look to that in terms of making sure that you are reaching your demographics. And the other thing that we need to look at is we need to look at people younger. We need to bring younger people into the C-suite so that they can make those decisions. We're holding on. I'm a baby boomer. We're holding on so much that if we don't get out of the way and let other younger people come in and take their licks and make their mistakes so that they can be better, it's not gonna play out well for us. So the high touch and high tech is what I would recommend that credit unions look at, and then a win-win vendor relationship. What I love about ACUC and our vendor partners is that we partner with people like CUNA and NCUA. We look at them as a partner because they're using critical data to ensure that we are successfully reaching everybody. And that's what's most important. I say we keep our eye focused on what credit unions were built for, serving the underserved with equality and equity. So that would be the focus that I would look at, equality and equity.
Thank you so much. Mike, looking ahead to the next 6, 12, and 18 months, what are your expectations for the broader economy? And how do you foresee those economic trends impacting the work and operations of credit unions?
Yeah, so as I said earlier, we are not at the moment saying that the economy will fall into recession over the next 18 months. So that's the good news. The not so great news is that doesn't mean that we're not going to see more stress. We're going to see way more obvious stress going forward. And that means earnings challenges. That means changing risk profiles and changing in a not so great way. And it also, I think, means that there will be additional challenges from a competitive perspective as well. And just to kind of drive that message home, the canary in the coal mine in terms of stress, I think, is when you start looking at unsecured credit, and we're seeing big increases in unsecured credit, and especially big increases in credit card balances in the United States. That's a pretty good indication that people are stressed. The $3 trillion in excess savings that flowed into depository institutions is almost all gone, and almost all of what remains with wealthy folks. So we're seeing those big increases in balances. We're seeing bigger percentages of people that are carrying balances, and those that are carrying balances, again, are carrying bigger balances. So that's not so great news. We're forecasting pretty strong deterioration in asset quality because of that. We do think that liquidity pressures will remain obvious throughout our forecast horizon. We think that loan growth is going to be quite a bit lower than it has been recently, but savings growth is going to lag loan growth. So that means loan to share ratios will continue to inch up if we're right, and those liquidity issues will be impactful. No question about that. Got a whole bunch of long-term assets on our balance sheets. Those have grown pretty significantly over that period of time where we refinanced 30-year mortgages into 3% mortgages, and our longer-term assets have gone up because of that. So there's a lot to worry about. The good news is that, for example, credit quality is deteriorating, but as Board Member Hood pointed out, we started in a pretty good place. We were near all-time lows on both delinquencies and net charge-offs. And so that's a pretty good position to be in as you enter increasing economic uncertainty. And the other part about it, of course, is that the credit unions really always have reflected a tremendous amount of flexibility and I think resilience during economic downturns because they've remained mission focused, because they are firmly focused on purpose, because they were created during the Great Depression, and because the for-profit sector has been created to maximize shareholder value. So in tough times, for-profit institutions are licking their wounds and turning people away and protecting shareholder value. That's their fiduciary obligation to do that. Our obligation is to lean in. Our obligation is to use capital wisely, not use it up, but to use capital to get people through faster than they otherwise would. We've always done that historically in the payoff at that to happen. But I would say, in terms of advice, as you go forward, be thinking really about the impacts that you have. Begin to socialize those changes. So I think it's super important and will pay big dividends.
Thank you. Rodney, as credit unions navigate the future, what role do you envision for regulatory policies and support from organizations like NCUA in fostering an environment conducive to credit union success?
Well, I think the best thing we can do is to provide a regulatory framework that's transparent. My philosophy is that regulation needs to be effective and not excessive. So I want to make sure that as we're navigating the days ahead, that we are really making sure that we are providing empowerment for credit unions to serve their members. And when I talk about empowerment, that means Renee and Mike, we've all talked about fintech. Are we giving credit unions the empowerment and the flexibility that they need to have these third-party vendors and these relationships? Also, are we providing opportunities to work collaboratively with the credit unions? I think gone is the day of playing gotcha with your regulator. I think at the end of the day, we all have a vested interest in ensuring a win-win. And what does that benefit most? It benefits 135 million members. So that means during training outreach, we did a lot of training around, I mentioned the deposit insurance fund. You all were also training and doing things now around capital. We're doing a lot of training also around liquidity. And yes, we've talked about tightening liquidity. One of the things that you're going to see us do is giving the industry more guidance about non-member deposits. How do they better use our central liquidity facility? How do they foster relationships with the Federal Reserve Bank in the discount window? So it's us being, I would say, that trusted partner. And I know you don't normally think of a regulator as being looked at as a partner, but I think that is the approach it's going to take to really provide credit unions with the certainty and the guidance they need to compete in today's 21st century environment.
Thank you. I'm hearing a little bit of background noise. I don't know if anyone else is, so it might help if the person not speaking mutes themselves. We'd like to end the discussion part of today's webinar with a quick call to action from each of our panelists today. I'll throw this out there for all of you. What are your top 1 or 2 recommendations to credit unions in this challenging economy and times? Would you like to start, Renee?
Thank you, Jessica. Building your brand as the financial institution of choice is key. Getting into your community and making sure that you are the financial institution of choice for your community. Educating your board and your board of directors and your supervisory committee, making sure that they understand what the goals are for the organization and for their community. So those would be the things that I would look at.
Thank you. Rodney, would you like to go next?
Yes, my 2 would be first and foremost, as a regulator, I want our regulated entities to focus on the fundamentals of balance sheet management, looking at credit risk, interest rate risk, looking at data privacy and protection, all of the things that you would expect that well-functioning institutions are going to perform and look into. So we'd like for them to focus on the fundamentals, the banks and others that have had a bit of hiccups these days, it's been because they took their eyes off of some of those fundamental things regarding well-run institutions. And I would say the final piece, and that is continuing to learn and explore fintech. And I'm not saying that they're a panacea, but they can play such an amazing role in helping credit unions serve members and also get greater scale and efficiency.
Thank you. Mike?
Well, preaching to the choir here, perhaps, but I would say, spend less time looking in the mirror and a lot more time looking out the window, because out the window, that's where the folks are that are going to really need your credit union over the course of the next 18 months.
Fantastic. So we'll use the remaining time for Q&A. And one question that has come in from the chat is, speaking of helping the community, is there any information on the political movement of the CDFI program?
I don't know about the political movement, but I would just say that CDFIs play such an integral role in helping bring capital to underserved communities. I'm proud of the fact that of the nearly 4,700 credit unions that are NCUA overseas, that about 400 of them are CDFI certified. So I recognize that there has been a bit of a delay and a lot of approvals of new applications that people were looking for the CDFI designation. But the main thing is that I'm just proud that credit unions, we have groups like AACU and CUNA who are providing those CDFIs for a lot of the tools that they need to stay relevant and sustainable.
Great. Renee, a question for you. How can credit unions leverage data analytics and member insights to make informed decisions and deliver personalized experiences to their members?
Oh, I love that question. Thank you, whoever did that to me. Adrian Johnson always says, stick to the facts. He's a CFO, EVP at MICU Credit Union. Sticking to the facts. If you're using the data analytics, the data doesn't lie. We can certainly position the data to influence the way that we want it to be influenced. But if you're looking at raw facts, the data doesn't lie. So if you're looking at the data to ensure that you're reaching the audience that you want to reach, they're giving you the information. They want these type of products. They need this type of assistance. They're whatever age they are, whatever things they're going through, use that information to build the products and services at your credit union that are going to assist you in making sure that you're reaching not just the underserved, but the community at large. And so I would say that data mining is essential to a credit union that's going to be moving forward. You cannot exist without understanding what your people are looking for so that you can then address what that looks like.
Okay, we're nearing the hour and want to be respectful of everyone's time. A huge thank you to all three of our panelists, Renee, Rodney, and Mike, for your time and the insights that you've shared. Thank you also to our attendees for being here and for the thoughtful questions. If you liked today's content, CNote has a monthly community newsletter where we share similar information and insights that we think will help credit unions succeed. And if you're interested in receiving that email, that newsletter, please feel free to email us at deposits@mycnote.com and we will add you to our list. Thank you again to everyone and wish you a wonderful day. Bye-bye.
Bye-bye. Thank you.